Hello, Jags. This is Fahad. Thank you for joining for the second roundtable discussion between me and Tom. Hi, Tom. How's it going?
Good, Fahad. How are you?
I'm doing great, man. Always.
Good.
I think you will find this particular episode from the last one, compared to the last one, very interesting and a lot more actionable discussion on various stocks, as well as a high-level view of where we are going with the market and what sectors are starting to outperform at this time in front of us. So with that said, let's get started.
All I hear about on TV all of a sudden again is this 10 minus 2 yield curve is inverting. Yield curve's inverting. Should I be scared? Does it matter?
Yeah, you should be selling everything, running around the house, just going out of the... No. I'll tell you this. The yield curve does matter, but it matters when you look at the history only to the extent when you can actually have certain sectors that benefit or do not benefit from it. Put it differently, from the total economic standpoint, yes, it does matter. The market standpoint, it also matters. But the span at which the yield curve will actually affect the markets could be very, very wide. And timing it is practically nearly impossible. So let me just give you a quick history over here. The last 7 recessions in the United States, all of them were preceded with a yield curve inversion. And I'm talking about over here 10 minus 2 spread inverting. Now we already have 3 minus 2 inverted. You saw that yesterday, right?
Yep.
I mean, the Federal Reserve came out and it basically immediately threw 3 minus 2 and 5 minus 2 into the negative territory. This morning, the 7 minus 2 also inverted. The only thing that's hanging out there now is 10 minus 2. So everybody, that's the one that you were probably looking at.
Why does it happen in simple terms?
It happens because the inflationary expectations for the long term, basically they start to come down with a slowdown in economy. And what you saw in the Federal Reserve statement yesterday, they essentially knocked the expectations down for the broader economic growth. They really took it down to the point where they basically believe we are slowing down over here, so we're going to have to basically take any kind of rate hikes off the table. That acknowledgement that the growth is indeed slowing basically caused the inversion to sort of accelerate.
And even if they start to cut from here, while the low end of the yield curve will come down, it won't come down fast enough. This thing will flatten and invert.
Oh, it will. And right now the chances of this, I mean, there was a moment in December when we were talking about this last time that the difference between 10 minus 2 had come down to about 9 basis points. And then it expanded from there as the market rallied. But with this new FOMC going ultra dovish, putting off any kind of rate hikes all the way up until 2020, and also stopping any kind of tapering of the balance sheet, basically what that did was it accelerated that once again. So now we're starting to see the basis points basically contracting. Chances are, at the rate I'm looking at them, you're going to get the 10 minus 2 yield curve inversion sometime in the second quarter.
So that's the background we have now. Chances are good that by the end of the year we could be in a recession, or we're at least slowing down. I think we know that at this point.
You see, this is where it gets tricky, though. It's very easy to just assume that just because the yield curve has inverted, it's basically time to go to cash or it's time to move to the sidelines and there's no opportunities out there, none of that. I don't want to actually put that particular stereotypical thought in people's mind over here, because that is actually entirely not true. The most important thing, first thing that I want to remind people over here is that the average time span after the 10 minus 2 spread has inverted before the S&P peaks is about 7.6 months. Looking at all the last 7 times this has happened. Now, 7.6 months will practically put us at the end of the year, right?
But it is a wide range.
It is a wide range, exactly. So that's why you can't time it. So if you actually don't look at it, the average or even the median, if you just look at the spread of how much time, going all the way back to 1956 when we were observing this rating, so this data, it's anywhere from 1 month all the way to 22 months. So if I'm going to come here, I cannot tell you, I cannot predict whether the S&P is going to peak in 7 months or 10 months or 15 months or 20 months. I have no idea. And frankly speaking, the economic data is not slowing to the point where the consumer is simply, a little bit slow down here and there, but it's not affecting the consumer yet. So this could very well be the case where the yield curve does flatten out, but we don't just straight go right into a recession. It may still play out with the S&P still rising for quite some time.
It's a good point. And so if we can't really time when this thing is going to happen, to turn this into something actionable, what then? Can we find sectors that outperform?
Yeah, there was a fantastic study that we did in the fourth quarter Jaguar Outlook, and I've been pointing this out more and more in the last couple days. And it's also becoming my basis right now to basically start picking trade ideas and recommendations of what stocks and what kind of sectors to bet on going into the second quarter. What we realized, what we discussed in the fourth quarter was that there's only one sector that consistently, looking at all the yield curve inversions that have taken place in the past, always stand out. Whether you look at 6 months, 9 months, or 12 or even 18 months time frame post-inversion, that consistently always tends to outperform the S&P. And that sector is healthcare. Now, when I say healthcare, it includes a whole bunch of other things. It includes health insurance stocks, it includes the pharmaceuticals, the biotechs, all kinds of things. But there's one particular subsector within healthcare that I believe is the strongest of all, and that's medtech.
And just to be clear, too, it's not because the yield curve inverted that healthcare outperforms. It's just a natural best defensive sector we find, right? People always need healthcare.
Yeah, let me just put it this way. You know, naturally, if there's going to be an economic slowdown, what do you think people are going to cut first? Big ticket items, right? They're going to put off buying a house. They're going to put off buying cars. Then they're going to move down the chain. Then they're going to start putting off the more basic stuff, clothings and all kinds of other small stuff, and then it finally trickles down to the absolute necessary stuff. But there's one part of the entire economy which never slows down, and that is healthcare. If you're sick, doesn't matter you got a dime in your pocket or not, you're still going to go get the treatment.
Right.
I mean, it doesn't matter how bad the economy is. So basically, it is the most ultra defensive sector that is out there. So naturally, this is why this sector tends to always outperform all the other sectors when the economy starts to show signs of slowing down.
Good.
So I have a chart here, and I think you're going to find this one very interesting to go along with that healthcare stock. Take a look at this one, folks. Now, back when we talked about in Q4 Outlook that the healthcare is going to outperform the rest of the sector because we're going to have the yield curve inversion coming soon. This is a ratio chart of medtech sector, which is the symbol IHI versus a SPY. And it speaks volume. If you just look at this, it is telling you how the sector for the last 6 months has been steadily outperforming the whole time. Take a look at just in the last couple of days. Pull up your watch list or whatever broker you use and take a look at Stryker, Medtronic, Abbott Labs. Or you can go down to the mid caps or even the small cap med tech stocks. They all just continue to perform quite remarkably. And that's essentially what's happening. You want to focus on names that are not going to just provide the ultra defensive nature in the market if the yield curve inversion happens, but also that has a very strong technical momentum.